It's time for Smart Charts with Abigail Doolittle, where we look at timely topics through the charts. And this week, Abigail, you're looking at macro fundamentals through the charts.
Yes, we are, Scarlett, and it's sort of fun because usually we're just looking at the financial markets, but today we are looking at a charted picture of the fundamentals beneath the charts in those financial markets. To do this is Michael Sheldon of RDM Financial, Chief Investment Officer over there. And thank you so much for taking the time. And this really is a treat because we're usually looking at the charts of the S&P 500, the 10-year yield, but here you have the corporate profit outlook over the last decade or so. So talk to us. Clearly, it's going in the right way out of the financial crisis.
Sure. So I thought this was an interesting chart to bring along. It shows the corporate profits over the next 12 months, going back since about 2010. And one of the things that's interesting is corporate profits have tended to trend higher over the past decade or so. They've been fairly consistent. But there are a couple of things that stand out. If you go over to the period in 2011, 2012, there was a bit of a consolidation there where it looked like earnings were plateauing. Then they took off again. And then in 2016, 2017, once again, earnings sort of plateaued. There were a lot of developments around the world going on. And then that leads us to the period today where in 2019, corporate profits have really either tread water or they've actually been down slightly over the past few quarters. So we think looking ahead to 2020, our outlook is moderately constructive for next year. We think a lot of central banks are cutting rates, and that should lead to a pickup in global growth as we head through next year. So we think corporate profits should start to pick up again, similar to the way they did in 2016-17, and then after the slowdown in 2011-2012.
So climbing right out of that plateau. And so if we connect that to the S&P 500, it sounds as though you would be a buyer of stocks, supported by a strong corporate profit outlook?
Yeah, we think that stocks tend to follow the direction of corporate profits over time. So that's one of the things we're watching. And if corporate profits do start to improve, we think that could provide a bit of a tailwind or a positive for equity markets as we go through next year.
So let's bring the jobs picture into the equation here. This is a very interesting chart.
Sure. Many people look at, when they're looking at the markets, they look at employment. That's very important. They look at the monthly jobs numbers. They look at weekly jobless claims. We wanted to show things a little bit of a different perspective. So what we show here, the blue line is the number of unemployed, and the white line is the number of jobs that companies are looking to fill. So for much of the current expansion going back to 2010, you can see that the numbers were reversed, where there were a lot of people looking for work, and there weren't as many positions that companies were looking to fill. In early 2018, the line switched. And today, what that shows is there are 1.5 million more jobs that companies are looking to fill than there are available workers.
So that's a very optimistic picture. Do you remember the last time where there was that sort of a cross, when it was, in the green, so to speak, in terms of jobs? And I have to imagine this would probably be good for the S&P 500 too, unless it cut into margins, if employers having to start finally boosting wages.
Sure, that's important. There are a couple of questions there. You have to look at hourly earnings, and that could have a negative impact on corporate profits over time. Average hourly earnings have not gone up that much, and there are a number of reasons for that. Outsourcing of technology is one, for example, productivity, the internet. But the other question is, unfortunately, the white line doesn't go back that far. It is created by the BLS, the Bureau of Labor Statistics, but it only goes back to about 2000.
So it's certainly a bullish picture. And to tie all of this together, this is another interesting chart. We're looking at high yield spreads here in about 30 seconds. Talk to us about high yield spreads and being super tight and what that means.
Sure. We look at a number of financial conditions and financial indicators. And what this shows, this is a spread between high yield bonds and interest rates. And typically what happens when the spread is declining or low, that's a positive sign. It shows the financial health of the markets is fairly solid. When the line starts to trend up, investors are a little more worried about the outlook for corporate profits in the economy. So typically in the last two recessions, this line has peaked about 11 months before a recession. So it's something to watch in 2020, but for now, investors are fairly positive, at least on the outlook for corporate profits.